Welcome to TradeTheMBI.com. This is Jonas. Report is for the 31st of December. A tumultuous year comes to an end. Well, not so much for the market, even though there was quite a bit of movement. It was all still relatively within our general expectation of the continued rise due to devaluation of the dollar and the forced appreciation of real assets. It's a common thing that typically happens in inflationary environments. We were talking about the expectation that with the weakness, we would have some continued follow through, but that it would likely hold relatively to supports now. And the ES actually faded through the 50% quite quickly. But in the NASDAQ, it really wasn't as dramatic. If we take a look here, it supported right off the 50%. So, and that was the strength overall, and it pretty much tied into it pretty cleanly. But still, even though we had DOC with rising green over red, we had also at the same time the rise of orange. In this case, now orange fades, shorts increase just a little bit, but so did short-term buyers to kind of stave off the potential of gloom and doom. But there's a lot of portfolio rollover and everything at the end of the year just to finalize your last tax liabilities and get everything clean to start the new year. But all pretty clean. Those are big numbers the market finishes from the start of the year. So really can't complain from that standpoint. Treasuries, of course, in disaster zone because that yield keeps rising despite the fact the Fed's easing. And that just says the market has zero confidence in the reality. But from a U.S. standpoint, obviously lower interest rates means, and also with the way they do their CPI, they give lower increases for Social Security and some of the other things. These are all technical savings, so to speak. The biggest problem here is this oil continuing its rise. And this is what we talked about. Everyone was like singing the demise of oil as soon as Trump was in. I was like, it's going to take longer than that. That's not a panacea by any stretch of the means. It takes time to flip that, and you'd be near the end of his first year before the effects of making those changes dramatically have an impact. But forward looking to the market, you would think that by the middle of the year, if the policy changes are dramatic, then you would definitely expect to see that decline. That would be deflationary in nature, and Fed wouldn't know what to do with that. They may raise rates arbitrarily just to counter that because they really don't know how to handle deflationary constructs. It's just a nightmare for a Fed-based system. And the euro is holding on. That's the best you could say for it. The continued catalyst from Europe is ugly as far as where they're going economically, and that they got zero chance of surviving. Gold being suppressed at this particular point doesn't really surprise anyone. So what do I mean by that? Well, think of it in relative terms. Gold's up about 18%, pretty much the same as the market. While you've experienced an enormous amount of currency devaluation, at least from a fiat standpoint, and the relative move is consistent. Really doesn't make any sense. When you look at it, something that has a fixed supply setup, Bitcoin represents, almost 100% move. And that gives you a clear idea because in reality, we've seen prices and a lot of things double from a real world standpoint. And that's closer to where Bitcoin is than the rest of the other quote unquote inflationary, elements. And this is why you've seen in a lot of stocks that same kind of increases because relative to where currency is, they really didn't gain much. This is a phenomenon that people always think about real estate appreciating. Not so much. What happens is it represents the devaluation in the currency, and that's why you saw such massive increases in price value in the 70s, and likewise even now, as we've had what has been money printing and a representation of inflation, and that was naturally for asset classes going to cause them to rise. And it's relatively basic economics. A lot of people misunderstand, where real estate appreciation and that typically comes from. But that is a primary factor in a Fed-based system where inflation is necessary. That's what you get. But you can see that this is you want to say canary in the coal mine. It represents to people exactly the failure in the system. Now, some will argue that's not a failure, it's just the way the system is, but it's always at the detriment to wage earners, which is supposed to be the productive class in any economy. If you're not producing a thing or making a thing, then you're just trading off of speculation, and that doesn't necessarily produce anything. And uh, it's a problem because this is what we saw with regard to the government spending. Adding more government workers and bringing in people that you then hand out money to, there's nothing productive about that. Yes, it will get spent and put back in the system, but at a diminishing return. And this is exactly the effect that we've seen. And that's why it's not effective, and it just creates further headaches, because at some point that's going to have to be paid back, and it can't in an inflationary environment. You can keep going beyond it, but when you stop that, it becomes rapidly deflationary, and debt payments are the cancellation of that value, and that's where you have collapse. And this is exactly what we saw in 2008 and that. And at some point, while they've been trying to avoid it, you're going to either have to switch to pro growth, which is actual production of things, in order to stave off what debt has been created. And have they reached a point where it's too far? No, not necessarily, but it makes it more complicated, and you're certainly going to have a lot more difficulty with it, which the only other way to get out of it would be innovation, some new product idea or concept that drives things to create new activity. When we look at it from an intraday standpoint before, so we had the fade off that took place, and of course they just filled it right back in. So it's just, again, playing with call buyers versus puts, and just evening it out and basically doing their best to cancel the move in general. And this is that mean reversion. And you can see here in post-market European session, very excited as everyone gets ready for this penultimate trading day of the year, and the excitement of the gains and the bonuses that they will get from the fact that the market went up, not through their own efforts, but simply by virtue of the rampant spending in that. So now you can understand why the Fed is reluctant to pull the rug out of the market, because then it would represent the fact that the emperor has no clothes, and that would be problematic, and that's why they don't do it, and why they're going to continue to try and fit between it. The bond market, on the other hand, has difficulties because those on fixed incomes and those relying on those interest rates are completely underwater relative to what's taking place with spending. And the reality is you're trillions off on the spending versus that. Now you can say that, well, the value of the U.S. or its economy is growing, and that makes up for some of it. It does makes up for some of it, not in totality, given the rate at which the spending increase has gone. And if you bring some of that stuff back in, then yeah, finally you might be able to catch up in half a decade or more. And this is the way they kind of look at it. But there are costs associated with that. That said, at the end of the day, we're able to see how these readings fold out, and it's been pretty clean so far from our standpoint. I expected that we're going to get a lot of the similar, but these people who think that next year is going to be a rosy one for the market, I think, are confused and misunderstanding how the economics of it are going to work, and particularly when it comes to having to rein in the disproportionality of trade imbalances and bringing that more into an alignment is going to create some severe pain. And so you should be ready for some volatility, which is going to be very exciting for us, because we're fine with volatility. In fact, I've always said this, that volatility is your friend, not an enemy. And since we're able to see a direction of a move, that volatility really is supported. Where you get sideways action, it becomes more difficult, and that's stagnation. And we haven't reached that state yet, but depending on the policies selected, we're dangerously close. So you can look for the new indicators for the new year to be coming out. Obviously, we have the holiday with New Year's. Hope everyone has a great start to the new year, and looking forward to exciting things. And we'll continue to solve the market for the foreseeable future, because this is pretty straightforward stuff. These guys really have not reinvented anything, and it just keeps plugging away for us. So we'll take it. As always, trade well, and hope you had a great year.